Good morning. Welcome to the Monday Market Update. I'm Nash Paradise, joined by my good buddy, fitness maxer, influencer, health nut, rave fan, dog lover, Andrew Katie. How you doing, bud?
I think you covered all the bases there. How we doing?
You know, that was just off the top of my head too. So I'm glad I didn't hit something I didn't want to say on a podcast. But, we're good. Let's we had a wild week. Let's get into it and talk about what we saw, what was going on, and then I'm gonna bring in Andrew Katie to really break down and digest what was going on so we have a better idea what's going forward. But we'll start with the volatility. It doesn't look quite as volatile on the chart, but man, this doesn't tell a great story. We're up, we're down, we're up and down on some of the same days. It was just not a real fun week for volatility. I thought we were going to be moving in a better direction. We knew it was going to be a lot of stuff going on, and ultimately we ended a little higher. Anything you'd add to that?
No, I mean it's we knew that, if you follow this and you listen to our last Monday, we pretty much warned, last week was the week of news. It was pretty much everything hitting at once. Fortunately, some of the news came in very flat. Some of the things that could have rocked us even further came in flat, like Bank of England's rate decision, Bank of Japan's rate decision. But yeah, we knew last week would be the fireworks week, and we got it.
Yeah, I'm going to go so far as to say everything was flat. And let's look at the chart from what happened last week here. And man, you can't, it's too much to try to see and break down here. But what you don't see is what really happened, which was, my goodness, there were not a lot of misses last week. We were like, forecasts were very, very close. Outside of a couple of like very rando outliers that, aren't generally going to move the market anyway. When we go through the important stuff, PCE, jobless claims, ISM, PMI, they were Johnny on the spot on the forecast. And I know revisions will probably tweak these, but when you're picking PCE to jump from 2.8 to 3.5, to jump from 0.4 to 0.7, hits 0.7. Like, there were no misses on here. Correct. Is there anything that jumps out for you in the data from last week that makes you think, oh man, this doesn't make sense?
Not really. I mean, the only thing that kind of was the shock to, I think, the markets, but not necessarily in a bad way, is consumer confidence. Mm-hmm. Consumer confidence was expected to go from, I think, a 92.2 down to an 89.4, and it came in at 92.8. It went up rather than going down. It's like we have this economy where we have a super resilient consumer right now, which is pretty dang wild.
Yeah, 92.8 was interesting. That was, Tuesday morning. And Tuesday morning when we saw absolutely nothing happen. Tuesday was a complete flat day. Wednesday is where everything kind of went wild, which, you'd expect. Okay, well, what happened? Well, we had the Fed interest rate decision. And outside of that, nothing important. I mean, core CapEx, okay, no. Crude oil inventory, maybe. Are we calling that a miss? It came in pretty short. But that's not usually going to move markets on our side, not like oil prices. But we'll break down a little bit more what happened at the press conference and what's going on at the Fed and how that relates to everything. We need to know what's going on this week and what we have on the docket. Compared to last week, it's not much. We've got ISM on Tuesday. That's a pretty big deal. ADP numbers coming out on Wednesday. Cool. And then, Friday, first Friday of the month, we usually really care and love labor because, man, it's Labor Friday. Do we care about labor this week?
Unless it's a massive miss one way or the other, I don't think it moves markets. I think you could miss by 20,000 up or down and not have it rock anything because all eyes are on conflict in oil. Now, if this would come in with a negative print on jobs and shock the markets, okay, that's going to upend it. If we would go gangbusters with a 200,000 job creations, we're going to see the market upset. But outside of a shocking miss up or down, I don't think it moves markets at all this week.
Yeah, and I think the interesting thing is a gangbusters hit on non-farm payrolls only looks like about 200,000 right now. Last month we were at 178,000, and now we've got a forecast of 60,000. So the chances of coming in high on non-farm payrolls, I think it is pretty significant. And with the absence of other, things this week, it could move the needle. But we could also show up with a 40,000 NFP figure. And okay, 40,000 jobs at it sounds low, looks low, but off a 60K forecast, probably not going to move anything. Anything else jump out in the week?
Now it's actually relatively, I mean, yeah, I say it's a quiet news week when what are we talking about? Jobs week is never a quiet news week,
Yeah.
but in lieu of everything else going on, kind of a quiet week.
100%. Yeah. A quiet week as far as econ data, but not likely to be a quiet week as we, refer to bonds and geopolitical conflict, oil prices. Like I said, we'll get into that in here just a minute. So moving on from this week's data, let's get into Fed futures. Now, this has flipped pretty significantly since last week. We were definitely trending down. In fact, I think we even had a couple of months here in the 325. Why has this upended so significantly to where now we're looking at, I guess technically there's one rando drop here in December of 2027, but definitely different than what we saw last week.
Yeah, it's because Jerome Powell says I ain't going nowhere. I
Mm-hmm.
ain't leaving. He's like the Wolf of Wall Street guy. I'm not going to say the word, but I ain't leaving. That's pretty much where Jerome Powell's at. We'll talk about that more once we get off the slide deck. But yeah,
Yeah.
I think that has spooked markets quite a bit for the future of the Fed, and people are now seeing Jerome Powell as the continued thorn in the side rather than the guy that's about to exit.
Yeah. And, the other takeaway here is as you get deeper than the next few Fed meetings, nothing matters. This stuff can flip one week on one side to another weekend. Like there's no forecasting this. We knew we were going to drop down to these levels. We're at these levels. Do we drop further? Maybe. Do we stay the same for a significant amount of time? That's also completely plausible. We could go, a year plus without any kind of movement from the Fed as far as the funds rate goes. That's not necessarily a bad thing. It's just a reality that we're working with right now that week over week, we're completely flipping by, 50 basis points when we're talking 18 months out. That's too hard to forecast. This stuff is changing week over week. So we're not going to put too much emphasis on this. But as far as what we got going forward, yeah, nothing really moving right now. So we'll keep the Fed's fund rate where it is. Let's talk about what we got next. Mortgage rates. We thought we were dropping. We did. And now we're right back up. So, I mean, how do you feel about that just sub 6.5 right now?
I think it's a psychological barrier for consumers. I mean, there's still, trust me, there's a lot of volume still being done. I'm still having really, really, really strong business, but I think it's a psychological barrier. I think consumers, when you start to get to that low 6% mark, it's a psychological shift from a 6.5 rate. And keep in mind, we've talked about this before, but rates being locked, like this is showing, call it, a 6.5 at one point last week. That's just the median on where things are being locked. Understand that most people's interest rates are going to be above that. Number one, this is the creme de la creme buyer. This is like your primary residence, top credit score, great down payment, all these scenarios. But this is also a lot of lenders that were probably floating interest rates, hoping they would continue to go down further, and are locking interest rates at potentially a little bit of a loss on this. So I think, if you're quoting a consumer today a 6.6, that's a psychological difference than a 6.2 or a 6.3.
100%. Getting up over 6.5% is significant. And the other thing is, we're not at 644 right now. That was close of business on 430. It's May now. And
Correct.
it is not a great start to May. We are going the wrong direction. We've got some wild movement in the bond market this morning, tracking with oil and then absolutely shooting into the stratosphere for 441 yield on the 10-year treasury without any support.
All the way to 448 without support at this
Oh
point.
my goodness. Wild jumps and movements. Oil came back down. You got headlines about missiles, being launched and hitting US vessels. And no, this has been debunked or denied. And who knows the truth to any of it. Oil recovers, bonds do not. And man, where do we go from here? Like I said, we're not at a 644. Does it shoot up 652, 653? Probably somewhere in that range. But like you said, over 6.5, not the most fun. There's nothing we can do about that other than, combating the psychological aspect with just providing good data, good insight, and helping people where they are. But I want to dig more into what happened on Wednesday, what happened at the Powell press conference, and what does it mean going forward if you can digest that for us in a way that we can understand because we're not all as smart as Andrew Katie.
Oh, well, I you just make me feel bad sometimes, Nash.
Yeah, well, I'm good at that.
So it's interesting that Powell has chosen to stay on. Keep in mind, only one time in history has a Fed chair stayed on as a governor after their term without the president specifically asking, and that was the only other time. Back in 1948, the exiting Fed chair was asked by the president to stay on and stayed on. But without that exception, you have to go all the way back to Hamlin, who was the first Fed chair in 1916 that voluntarily stayed on as a Fed governor. So it's very, very against what the precedent is what Powell's doing. And I do think it's spooking markets a little bit. He basically saying, I'm not going anywhere. And if you couple that with the Fed having four dissenting votes, that was the first time in 34 years we've seen four Fed members dissent on the vote. It's got markets extremely uneasy. Now, I think it's important to break down why there was dissension. It wasn't necessarily that four wanted higher interest rates.
Let me stop you and go back a little bit because we're talking to the people and I got to act like a podcast host here.
Okay,
What does
podcast.
it mean to dissent? What is that like? What does that literally mean in this case?
It literally means to disagree with the move that the Fed is doing. Like they're putting out the statement saying we are holding rates steady. And four said, I do not agree with that. Now, on face value, that can look like four want higher interest rates, four want rate cuts. And fortunately, we got the data behind it. One, Fed Chair Myron wanted a rate cut. Consistently has wanted a rate cut at every single meeting. So the dissent has just continually been there. So that takes one. The other three weren't necessarily against the Fed holding steady, but they were against the language the Fed was using because in their words, they said it was an easing bias for the future. But this is the first time in 34 years we've had four Fed members disagree with the Fed's decision. So I think we're seeing this kind of fractured Fed that really needs new leadership. And now we have Jerome Powell hanging on as a governor in the Fed. And so I think there's a lot of problems coming into this. Kevin Warsh is going to have his hands full as we come into this. And I also think, the jobless claims that came out, the news media ran with that on Friday. Jobless claims came down. I think it was down at like 80, what was it? 80 some thousand, 89, I believe. It was below expectations. And the news media just ran with it of the strength in the labor market. But I think there's something to be said about the fact that we're in such a gig economy post-COVID. I mean, keep in mind, the average Uber driver makes almost double what unemployment income is, the average Uber driver. And so there's a lot of people that have lost a job that rather than going and filing for unemployment benefits are just going to go drive Uber or do DoorDash or Instacart or something like that, because it's going to make twice as much money as they would being on unemployment benefits. So just because there's not a ton of initial unemployment claims doesn't mean that there's still not cracks in what's going on in labor. What's your thoughts, Nash?
Well, I mean, let's be honest. It's a spin. You look at the history on jobless claims. 214, 215, 220, 222. We came on 189. That's not that far away. Continued claims dropping a little bit from 1.8 million to 1.78 million, like getting under that 1800,000, which is weird the way they put that, but it's just it's not that significant, but you can spin anything to be significant.
Right.
And you do have people doing other things to get in the labor market. You do have this dichotomy of where are benefits federally, state, unemployment versus what can you do to, get something better, or what can, when you stop looking, when you're not actively trying to seek a job. Now you've changed things, and it's hard to digest all that. Unemployment rate is hanging pretty consistent. Like labor has been fine. So you almost have to stretch to find things in the labor market. And if you got a political bias for it and you're trying to convey a certain narrative, like you're going to be able to do that. Like you
For
can
sure.
absolutely do that. And a lot of people pointing to what happened to Spirit Airlines. I've seen both sides of the political spectrum using that as launch pads. Like people just want to fight. They want to have something to talk about. And there's not enough news in the Iran conflict right now to really hold the interest of the American people. So we see people going back to econ data, trying to find ways to support their arguments, but in reality, I don't know if markets care all that much. It's just hard to say with what we're looking at right now.
It is, and I think it's worthy of noting as we kind of wrap this up today. Barry Habib had some really interesting insight today on a potential kind of forced resolution to this conflict with Iran or Iran, however you want to say it. And it was kind of an interesting perspective. The blockade that's going on, the U.S. blockade of the Strait of Hormuz, there's an estimation that there's only about 1 week left for oil storage from Iran. Basically, they're still producing oil, but they can't ship, they cannot export their oil. And they're running into this problem that once storage hits capacity, the wells don't just stop. So they would literally have to shut their wells down, which can cost billions to return back on, and wells sometimes after they get turned back on never produce at the level they did before. And so there's actually talks about this could actually be the pressure thing that finally gets the talks to work. Is they're running out of places to put their oil. They're supposedly at this point just loading up tankers and putting them at sea because they're running out of place to actually put the oil that they're producing. And this can be a massive this could be an economic collapse of Iran if they don't solve something on that. So it's going to get interesting maybe over the next 10 days to see if we have any progress on talks coming out of this.
Yeah. And to your point, like money is everything. Geopolitical conflict is largely economic. Once you move past, any, you know, threat that you're dealing with, like money's the mover. That's why we use things like sanctions and, imposing tariffs, and the way that we do warfare now, it's economic. And yeah, if you're going to cut off, someone's ability to sell their oil and move things around, if that's a successful blockade, it's going to go one of two ways. It's going to go into violence, or it's going to go closer to peace. And you're going to have to move the needle. With that regime, it's hard to say that laying down and just folding into peace talks is going to happen. I think we may see an escalation of the conflict first, but to Barry's point and to what you just conveyed, it can't hold like this super long term. It's not well supported here in the States either. And, we're going to have to get some sort of resolution. Once we get some sort of resolution, it gives room for things to drop back down. The last point I wanted to make and just kind of leave us with here is to finish on, some bad news. I was looking at a Housing Wire article written by a friend of mine, and looking through the spread between the 10-year treasury and the overnight average on 30-year fix, it is skinny right now. A 4.41 10-year yield and a 6.44 overnight average on interest rates. I mean, we're right in that 2% mark. And you look at where things have been on the worst side, it's not great. There's not a lot of room there to keep squeezing. We really need to get these bond prices back down around that 4% mark, if not lower. And I found that interesting, but it's also cautionary that if you like it, lock it. If you've got a deal, sell it, lock it in. There is room for mortgage rates to continue to climb higher and to catch up to these bonds right now. And more unrest and instability is going to cause that spread to widen a little bit. So take that information and know, hey, just lock up what you got, find the wins, find the solutions, be creative, make sure you get your numbers dialed in. But I wouldn't be taking chances right now, because all the risk right now is for things to get more expensive.
Yeah, I could not agree more. And I don't. We don't just preach this. We do this. Okay, this isn't do as I say, not as I do. I think I hold the lock leaderboard for the entire company last week. Had a bunch of new deals come in and locked every single one, about $5 million in locks last week.
Ooh, no, I love that. There's tons of wins to go out there. I'm actually on that big leaderboard too, the one
Let's go.
for monthly funding. So, it's nice to be having that success. And, like I said, we do what we preach and we recommend what we're recommending for a reason. We've done this for a long time. Andrew's a lot older than he looks, and we've got a bunch of experience here. So when we say lock it up, if you like it, just do that and move on. Get the right information out there to people. Make sure you're conveying what's accurately happening. Most people don't have the information we just talked about. So be that trusted expert. You are qualified to share the information that we just shared today with people who don't know anything about this. That's literally your job. And be sure to join us next week as we digest what could be a really interesting week, watching bonds, oil, geopolitical conflict, and a little bit of econ data. And we'll be back here at the same time. Appreciate y'all.
See you.
Take care.